What is up, gentlemen? Mr. Chad in the building. I've already pre-recorded so many videos, so I have no idea which one is going to be the first one that I post. But I have a lot of raw audio clips, a lot of raw gameplay footage that I can use for my videos. Anyway, a lot of people get confused whenever it comes to investing, when in reality, investing is not such a hard concept to grasp. I think this is because modern society does not promote investing and financial education because financial education does not help our capitalistic society. You're not basically spending all of your income getting into debt to feed the capitalistic machine, the machine of capitalism. So that's why I believe they don't teach you any of this stuff in school, because consumers are a whole lot better for the economy than investors, to be frank. Both of them are important, but consumers are basically what make this capitalistic society go around. Which is why on this channel, I want to promote financial education for free, because a lot of people don't know what they don't know. They don't even know some of this exists, or that it's even possible to invest and become wealthy later on in their life simply by investing in the stock market. There are obviously multiple different asset classes that you can invest in other than the stock market, uh, like raw metals, like gold, silver. Uh, you can invest in collectibles, such as like rare Pokemon cards or baseball cards, football cards, stuff like that. You can invest in real estate. You can invest in small business. There's a lot of things you can invest in, to say the least. But one of my favorite one of my favorite vehicles for investing is the stock market, because these days it's pretty accessible. Stock markets are pretty accessible these days. And now there's not even any fees for making any trades or making any purchases. Apparently, back in the past, I started off with Robinhood, so I didn't really have anything to draw on. I thought just buying stocks, you know, I just thought buying stocks and having stocks was basically just free, like there's no fees for putting money in or buying any of these stocks, but apparently that's how it was back in the day. Now there are a bunch of brokerages that allow you to make transaction fee free purchases. So I can buy a share of Apple without having to pay like a Fidelity or Charles Schwab or Vanguard any money in order to do that. Like there's no middleman fee anymore. So the more accessible, there's no more fees, and it's pretty passive. You can make it as active or passive as you want. And unless you're trying to be a stock market mogul, or the stock market just fascinates you that much, I'd 100% recommend staying towards the passive side. And I'd honestly kind of recommend to make it as passive as possible, to have as many automations to investing as possible. So there's no mental effort or mental bandwidth being used in investing. So let's talk about the two different strategies that are used for stock market investors. Stock market investors either choose to invest in growth or they choose to invest in income, which are also dividend stocks. So growth stocks, essentially you are investing for the capital appreciation. Essentially, like let's just take Tesla for example. Let's say Tesla's $100 and over the span of a year, from January 1st to January 1st, Tesla goes from $100 to $200. You just double your money. You didn't get any more shares. You didn't buy any more shares. You have one share, and that share increases in value, on paper at least. Whenever you invest in the dividend stocks, you are mainly focused on the dividend, the amount of income that you'll be getting for the money that you're putting in. It's not just the amount that you're getting at this moment. It's not about just the yield, as in like the percentage number of income that you get from the actual stock price. You also have to take into account the growth rate of that dividend as well, because dividends, the income that the stock pays you, SCHD, for example, gives you about 4% right now if you bought it at this current day, a little bit less. But that 4% dividend payment is getting increased about 10 to 11% on average, not including inflation, not including inflation and all those other hidden hidden costs per se. So on a year by year basis, the economy usually inflates at about anywhere between 2 to 4% a year on average. There's the whole Biden administration, like inflation was way worse, man. Inflation was way worse. It was like 7 or 8%. So let's just say your dividend investment year over year increases by 10% and the inflation goes up by 2%, then in total, like you basically get a raise of 8% in that scenario. So you also have to, not only do you have to weigh how much money you want to be getting now in the dividend yield, but you also have to take into account the dividend growth as well. Because if you get a stock that pays you like 12, 15% yield, but has a growth rate of like 1% or 2%, over the long term, you're actually losing money. The money that you're getting paid is getting lower and lower because let's just say it grows at 1% a year and inflation is at 2%, then you're losing 1% buying power every single year. And you can see how that compounds downwards. So you can't just go for the highest yield, and you go for the highest growth possible, then that yield that you're going to be getting now is going to basically be non-existent. And at that point, you're basically investing in this case, dividend growth. So, so as I was saying, there are two different types of um, dividend investing strategies. I personally like to include growth, dividend yield, and dividend growth into my portfolios. I'm more of a fan of growth because I'm at a young age and I have a lot of time for this money to compound on itself. So, but uh, like I said, there are the dividend growth stocks. have a lower yield up front, but end up growing their dividend payments by a larger amount every year. And then there are the stocks with a with a high dividend yield that pays you more upfront now for the money that you put in, but grows slower over time. So you have to take that into account as well. So here's some pros and cons of growth and dividend investing. I'm gonna start with growth. Start with growth first. So a pro of investing for growth is that over a long enough time horizon, you typically get the most total return. I'd recommend investing in a growth ETF because it diversifies your position and you are capping some of that upside because you are diversifying, but you're also capping the downside as well. So, um, over a long enough time period, a growth stock will overtake a value-based dividend stock in total returns. And total returns is basically just the capital appreciation, like the stock price going from like $30 to $50 the next year, so on, so on. The dividend payments, as unlike the monthly or quarterly or yearly payments that you get from your stock, and any sort of interest that you get on that as well. Like if you have a savings account and it gets like 3.6, 3.7, that's about what I'm seeing right now. You have to include that as well if your stock has that. It's also the easiest and fastest way to double your money. It's a double-edged sword here, all right? Because it can go both ways. Because, so I'm just gonna put together these 3 points that I have here right by my side that I'm referencing right now. It's easiest, it's the easiest way to double your money. And this is because growth stocks are usually market leaders in innovation and new products. For example, AI is a great example of a current innovation, a current new technology that is just totally blowing up right now. All the AI stocks are just going through the roof. And because it's just so speculative, so new, we don't know how big AI is going to get. We don't know how impactful it's going to be. It's kind of up in the air. It's kind of like the internet. Like people didn't really know what the internet was back then. They didn't know how big it was going to get. And yeah, there's a real big possibility that you can throw $100 in today and double it within the year. I invested in the Palantir last year, and it's up 300% right now. Absolutely crazy. But that is the power of those growth stocks. They have the potential to shoot to the moon, but it also goes the same in reverse. They also usually outperform in bull markets because they are the innovation leaders. And that's when a lot of people start investing money into the stock market whenever they see good opportunities that they can pick up at a decent price. Or if nobody knows, like cryptocurrency, or like I said, these AI stocks, no one really knows what it's worth right now because they don't know they don't know how significant of a role it's going to play future down the road. So like evaluations are kind of uncertain, so they usually outperform in the bull market, which is a market that is continually rising and climbing, getting bigger. And a bear market, for for reference, is the opposite of a bull market, which is whenever stocks are tanking, they're gradually going down. I think a bear market is there's like a fine definition for it at like X amount of percent. If the economy goes down X amount of percent in a X period of time, it is considered a bear market. But that's a little advanced right now, and I do not have that written on my reference note. let's go over some of the cons of growth stocks. Like I was saying earlier about the double-edged sword, there is a lot of volatility whenever it comes to growth stocks because people don't really know where everything is valued, because you have to look so far into the future and kind of guess how big this is going to be in the future. Um, like people don't really know how it's priced, so it's easier for investors to freak out and pull their money. And there's a really good opportunity for you to double your money, but at the same time also lose that money just as quick. Um, and the same kind of like builds on top of that as well, the overvaluation. Growth stocks are usually um, traded at a higher price to earnings ratio, which means you are paying more. It basically means that you might be buying these growth stocks at like basically at a reach. You're overpaying for these. There is a good possibility that you are overpaying for some of these growth stocks. For example, if AI somehow doesn't pan out, a lot of people have the future. Like people are basically guessing that this is going to be part of our daily life, kind of like the internet. And if somehow AI flops, you know, these stocks are going to absolutely plummet because so many people are putting like they're betting future gains and future utility as part of the stock price. So you can see how this can make things swing up and down. And there's also usually no dividend income whenever it comes to buying these growth stocks because dividends aren't free money. They're coming out of the total profits, the total cash flow from the business. So in growth stocks, they usually tend to, instead of paying out the dividend, instead of paying out the shareholders, they take that money and they reinvest it back into the business because they think that that money will end up making their shareholders more money because they think they can utilize that capital better than us. And they're basically just bringing in all the profit and trying to reinvest all of that money right back into the company, trying to grow that company as fast as possible, which is why, the stock prices are usually go up a lot more. Um, yeah, why the growth is usually capital appreciation is just so much crazier with these growth stocks. So you basically usually get no dividend income with these growth stocks. Tesla, for example, but Microsoft and I think Nvidia do dividends, but they're so little that they're basically nothing. They're kind of just like a cherry on top. A 1% dividend yield or 0.5% dividend yield, you're $100, you're getting $1. I mean, it's still something, still something. I mean, I'll take a 1% dividend yield over a 0% dividend yield, but you're not really investing for the dividends. So all the gains that you make are all on paper. And what I mean by that is you don't make money until you sell. So no matter how much the company grows or how much the company loses, like you'll still have the same exact amount of shares that you started with if you didn't put any extra money in afterwards, obviously. So it can double, it can go up to like $1,000 and you still own 5 shares. Well, that's not your money until you sell the actual stock itself. And the scary thing is it can shoot all the way up and then you decide to hold it and one day your stock is worth $1,000 and then the next day you come back and it's dropped by half and that same stock that you just had is worth $500 now. So basically all the profits and losses are on paper. Like they're they're not really real until you pull the trigger and actually sell it yourself. And that comes into the market timing. Whenever you invest in growth stocks, you're basically planning on using the capital appreciation to fund your lifestyle and retirement, or financial freedom if that's what you're investing for. So, for example, if you're wanting to retire, let's just say you're wanting to retire, and uh, the first month, the market's doing okay, second month, market's doing okay, but on that third month, the market drops by 50%. Well, let's just say if you did not plan for that in advance, which is basically impossible to, because nobody controls the market. The market is basically its own living, breathing thing. It's gonna do what it wants. So if you were selling one stock for $100 on the first day, second day, and then it drops by half, you're now having to sell two shares for $100. So you're eating through your portfolio at a faster rate if the stock market decides to totally crap itself right whenever you decide to retire. So there is some I guess worry. It's like a worry or stressor in your back pocket having to think about like w will I still be able to survive if the market crashes whenever I want to retire? And uh this is where I'm going to start talking about dividend stocks and the pros of dividend stocks, because dividend stocks are kind of like the yin to the yang. You know what I mean? Like for dividend stocks, you're actually getting a realized return. So with dividend stocks, depending on which ones you get in general, dividend stocks, you're at least getting some sort of realized return from your dividends. So instead of that company taking that money and reinvesting it back into the company, they actually just give you the cash instead, which means that you're actually getting an income stream from it, which means you do not have to sell any shares in order for you to make any income. And that's honestly the part that I love about dividend investing. So even if the stock completely crashes and goes bankrupt and the capital appreciation goes to zero, all that dividend income that you made during that time, like you still get to keep all that, which is really awesome. Companies that also pay dividends are usually also more developed and stable. So Nvidia just started paying a dividend not too long ago. Microsoft started paying a dividend not too long ago. Like those companies are starting to become more established, even though the dividend yield is still pretty low because they are still a bigger tech company that still focused on growth. Like they're more stable companies. I hope you're getting what I'm trying to say here. And that's obviously good because if you're more established and well known and your reputation is out there, kind of like Coca-Cola, like can't really outcompete Coca-Cola. Like you can make a Royal Coke, or you can make like your own, like a Members Mark Coke, or you can make like any off-brand Coca-Cola. Like nothing's gonna beat actual Coca-Cola, and that's the whole point that I'm trying to get out. Like no one is really gonna dethrone Coca-Cola unless they absolutely just nuke themselves somehow. Like I can't see Coca-Cola going out of business. Will they? Could they drop and fall? Yeah, of course they can. You know, they're still a company, you know, they're not invincible. But the chances of them going out of business compared to like a tech stock that's utilizing a lot of leverage and debt to grow, it's a lot safer option for your money. And like I was saying earlier, um, you don't need to sell any of your shares in order to make money with dividend investing. And that is what I love so much. So in that situation where you're about to retire and you're investing for dividend cash flow, even if the market drops by half, if you got a bunch of dividend aristocrats in your portfolio, which means or dividend kings, which means they've been paying dividends and growing their dividends for X amount of years. Like even if the uh the stock capital goes down, you'll still be getting those dividend payments in, so nothing really changes unless you're wanting to sell those dividend stocks. But if you wanted to sell your dividend stocks, you might as well go into growth because, they're two different strategies. You don't want to, it just makes no sense. It's like I want to invest in I want to invest in the dividend yield, so I'm investing into like Nvidia with a 1% dividend yield, something like that. Like that makes no sense at all. Like if you want an actual high dividend yield, you want to go with the stock or ETF that actually gives you a high dividend yield. Um, so yeah, they're also usually less volatile because they are more established companies. Um, the ups, the ups are also capped because they're more established. Like how much more is Coca-Cola gonna grow? I mean, they're pretty much already on like every single continent. Probably even in Antarctica too. There's probably a Coca-Cola in the fridge in a researcher's lab there in Antarctica. Like there's Coca-Cola everywhere in the world. Like how else are they supposed to expand and grow their business? Like how easy would it be for Coca-Cola to like double the size of its company or profit? Like it's very unlikely. So yeah, the upside is capped, but also the downside is capped too because they are more stable. Bigger companies that are more established, like they can take the hit to it. They have, depending on the company that you invest in, if they have a large cash reserve, they'll be able to stay afloat during all this turmoil and, basically survive the headwinds and make it out the other end and continue growing from there. So, what are some cons of dividend investing? So, dividend investing sounds amazing. It sounds amazing. It sounds like, why don't I just go with dividend stocks over growth stocks? They just seem so much more stable and reliable, and I just like seeing that money come in monthly or quarterly. Well, here's some things that kind of stink about dividend stocks that you have to take into account before you just go out and put all your eggs into the dividend stock basket. So, the one I'd say the biggest downside to dividend investing is the double taxation. So, like I said, dividends aren't free money; they're coming out of the company's profits. So at the end of the year, the company, the accountants go through all the money, like all the profits, and at the end of the day, they pay taxes on all those profits, and then they send their dividends out. They split up their dividends from their profits, and they send it to the shareholders. Whenever it hits the shareholders, they are on top. They are taxed on top of that too. So the corporation, has to pay taxes on the dividends that they're paying you. And then whenever you receive the dividends, you have to pay another tax on top of that because it is a realized return. You're getting money in. It's like an income stream. The good news is that most of the time, depending also on the type of stocks, uh, dividend stocks that you buy, they usually have like a lower tax rate than uh, normal W-2 uh, employee income tax. Like I said, it's also usually less upside. It caps some of the risk, but also caps some of the growth because it's more established already. Um, Over the long run, over like a 40-year period, growth stocks are pretty much going to run away with it 99 out of 100 times, at least in total returns. In terms of income returns, that can be a different story, but in total returns, as in the capital appreciation, the dividends that you get in, any sort of interest on it, over the long run, you're going to be getting more total returns with a growth growth portfolio than a dividend portfolio. So Pros and cons of a high yield stock. Pros are you get more money now, as in like you get more money for the money that you put in. So let's just say you get a 10% dividend yield from company A and a 1% dividend yield from company B. If you put in $100 into company A, you'll be getting $10 back in dividends at the end of the year compared to $1 with company B. But usually there's also less growth if they have more high yield up front. And that's whenever it comes into the pros and cons of a dividend growth. It takes a lot more money up front to have the same high income. So it'll take you 10 times as much to make the same income as company A with company B. But over the long term, you're going to be making a lot more money with the same $100 put in at the end of that long time horizon. So it's all about numbers. It's all about, how long, because if you only want income for like the next 10 years, like if you're like 70, 80 years old and you only plan on living for another like 9, 10 years, it makes no sense to invest in a dividend growth stock. Like by the time it starts growing and start making more money than the high yield, you'll probably be dead by then. So, you'll want to be investing in more like higher yield stuff. So it all depends on your situation, what your goals are, how long your time horizon is, how long before you want to retire, et cetera, et cetera. So what do I do? I'm mainly a dividend investor. I love I love that I do not have to sell any of my shares in order to be making income. I like I love seeing I love seeing the payments roll in every single month, every quarter, every half year, every year. I just love seeing that income come in. And since I invest in a decent amount of dividend growth, on top of that, every single year those payments are getting bigger and bigger. So not only am I getting paid pretty much on a set basis, but those payments are also getting increased as well. I just love seeing that. It's so motivating for me. Um, just to see that income keep growing and growing and growing, even if it is double taxed. It's more of a psychology thing, and it keeps me motivated and invested into this thing. With the growth stocks, like like I said, it's all on paper. Like I don't earn anything until I sell it, and I'm not going to be selling it for honestly a hot minute. So for me personally, I really like dividends for that reason, and the peace of mind for whenever I'm retired. I mean, I won't have to worry at all. Like, oh, is the market going to crash? Is it going to be up? I just know that I'm going to be consistently getting those payments in uh, every month, every quarter, et cetera, et cetera. But I also want to let y'all know that it's not only I don't only invest into dividend stocks. I don't think there really is anything in this world that I'm 100% on like this thing or this thing. Like I'm not 100% into dividend stocks, not 100% into only eating meat, not 100% into only buying Apple product. Like, I like to diversify. I like to have some safety nets. I like to have some stocks. Um, like for example, Realty Income, they're a higher yielder, but the growth is not so good. And honestly, long term, it probably is not going to be the best compared to if I put that um into like a growth stock. But for me, I really like the thing that I like about Realty Income is that they pay monthly. So every single month, I'm seeing that I'm getting paid by realty income, and it feels kind of like a paycheck, and it feels awesome. And it's more about that mental feeling for me. It's more about that seeing it every single month pop up, even though I know it ain't the most advantageous. It's just so motivating, and like it drives me to want to invest more and more into dividend paying stocks. So I have some higher yielders, then I have some high dividend growth, such as SCHD, uh, DGROW. I'm also invested in Microsoft, Visa. They have lower dividend yields, but over time, like they're compounding their dividend payments by a really good amount right now, like 15 to 16% year over year. You can tell how that'll stack on top of each other. Absolutely beautiful. So in my Roth IRA, which is a type of account, and I'll be going over that in another video, the different types of accounts that you can invest in and the advantages and the disadvantages of investing in those accounts. In my Roth, I like to invest in my high growth over there because any of the stocks that I sell in my Roth IRA are not going to get taxed and not penalized on capital gains because all that money put to that account is tax dollars. So have the high growth just to catch the swings up. I got the good dividend growth for my future older self, uh, a long time from now. Um, he's going to be getting paid really good money because I'm investing in these dividend growths. So I'm not really getting much now, but later down the road, it'll pay itself off in no time. And then I'm also investing in some high yielders like Avicii Properties, a Rexford Industrial, um, a Realty Income. SCHD is like in the middle of a dividend growth and dividend yield. It's in the middle, so I can, count it kind of as both. But I have that for me now, and I like to have that in my brokerage because, like, I can pull from it whenever I want. There's no, I have to be 65 in order to pull from it without getting a penalty on it. So I just like to have a mix of everything. So, I get the pros and cons of all those together. So, in conclusion, um, both strategies have their pros and cons. They're both valid strategies. You can make both of them work for you, depending on what you want. Um, and at the end of the day, if you're investing in good quality companies, it doesn't matter if you're investing in growth, if you're investing in dividend yields, or even in dividend growth. It's better than investing nothing at all. If you buy a really bad company, that's a different story. If you buy a low quality company, it's a good likelihood that it's going to go bankrupt and you lose the capital. But if you buy really good quality companies that you really believe that are going to be here for the long run, it is way better to invest in literally anything than it is to invest in nothing. Choosing one of these three strategies depends on, like I said, your personal goals. Like what's most important to you, your time horizon. So if you want the most overall return, growth stocks all the way. If you want more income now and don't mind that income not growing as fast, you have a shorter time horizon, or you just need some income to supplement your retirement or something like that, or you're close to retirement, high yield would be good. You still want some income, but you don't mind waiting a while for that income to really start growing and compounding on each other. Kind of like having a growth stock for your dividends. If you like the idea of dividends and not having to worry about having to sell your stocks, this would be a perfect, this would be a perfect dividend growth would be a perfect fit for you. So, hope this video was helpful to y'all. I might I might post this video and a written out version of this as well, but uh, covered in AI. I could do a voiceover with AI to make it more to make it more compact and streamlined and less choppy. There's definitely gonna be no uhs or pauses or any of those things. It's just gonna be way smoother with, I feel like, with the AI, and would also stop me from having to like re-record like a million times. It would definitely save me some time, but depending on what depending on what my viewers enjoy watching, like I'll probably do a voiceover and then I'll do an AI voiceover and then I'll just post both of them and I'll just see like what's up here. You know what I mean? Like if you just want something short and simple to the point, you can watch the AI video. If you want something that's more personal and uh, yeah, if you want something more personal and someone you can relate to, you know, you want to know that a human is making these videos and it's not just someone copy and pasting something from Chat GPT, then like that those videos will be out here for them as well. So wanted to thank y'all for listening to this video. I hope this help y'all out in choosing what's the right strategy for you. And yeah, I hope y'all make lots of money. I hope y'all are able to build amazing lives and build a nest egg. And basically, just build a safety net for yourself. Mr. Chat out. Adios.